third ring speaker in our series this fall, and it's a real pleasure again to welcome our guest. He's as most of you know, the chairman and CEO of Regency Centers, which is really the latest in a long history of respected real estate enterprises in Jacksonville and here in Florida that have gone under the Regency name. And his experience goes back to the beginning. His father founded the organization. Hap himself is very well known throughout the state and highly respected. For example, our advisory board of 100 and some leaders in the real estate all know of him and hold him and his company in very high regard. He's currently CEO of Regency Centers and has been since their initial offering in 1993. He became their chairman in 1999. But his roots with Regency go back farther than that to maybe 1976 or before. Most recently, he has served also at the national and international scene as chairman of the most important REIT organization that exists, I think, which is the National Association of Real Estate Investment Trusts. And you see information from them every day in the Wall Street Journal. That's the umbrella organization representing the REIT industry. And he's currently on the executive committee of REIT. And when I think of REIT, I think of they're as important to that industry as, for example, ULI is to the development organization. And to look and see that he's also on the board of governors for ULI. So he spans a wide range of areas. He's a graduate of Washington Lee and has an MBA from the Tuck School at Dartmouth. I noticed today that your stock is up 90 cents. I assume that's because you've also joined forces with the Gators now. So welcome to Gainesville and to Gator territory.
Thank you, Wayne. I've been a Gator probably longer than anybody else in this room. So my dad used to take me to Florida games since when I was 6 or 7 years old. So I go back to the first game back to the Silver 60s when Ray Graves was the coach, and I remember the old ball coach kicking the field goal against Auburn in 1966. So anyway. Before I cover the topics, anybody in here not read or seen Steve Jobs' commencement address at Stanford? I strongly encourage you to do that. It is extremely poignant, insightful, and inspirational. And even if those of you that have had it, and I've watched it and read it several times, it's worth reviewing again. It's terrific, and he's obviously one of the great business leaders and titans around, not only in this country but around the world. What I'd like to do today, and you're welcome to interrupt at any time, is just cover two basic subjects. One is real estate investment trust, and the second is tell you a little about our company, Regency Centers. Real estate investment, it's interesting. About 50 years ago, the real estate investment trust were founded or put together or legalized. There's I think it's the last piece of legislation that President Eisenhower signed, and it was part of the Cigar Tax Act, believe it or not. And real estate investment trust are companies that have to have the majority of their properties and a majority of their income comes from real estate. It's pretty simple as that. Stock's got to be widely held. And another important thing, because it's like a pass-through company, is that real estate investment trusts are supposed to have to distribute 90% of their taxable net income. Because the thought is that the trusts aren't going to pay income taxes but if we pass the income in the form of dividends to our investors, that the dividends will be paid for by the investors. Today, the industry is $500 billion. It owns about 15% of the institutional quality real estate in this country. Almost 30,000 properties across sectors, market cap of almost $500 billion, and 160 companies. And 140 of them trade on the New York Stock Exchange. And as you can see, the modern REIT industry, I mentioned that in 1961, REITs were authorized, but the modern REIT industry really didn't start until 1991 when Kimco, which is another shopping center real estate investment trust like Regency, and Taubman, which owns a number of really fine mall companies, went public. And had about $10 billion market cap today, and that's grown by almost 20% on a compound basis. And as I said, across property sectors, apartments, regional malls, shopping centers, healthcare, timber REITs now today. There's a company called Rayonier, which is a timber REIT based in Jacksonville, self-storage, hotels, industrial. And this slide, I think, is compelling because I'm a real big believer in the REIT model. And this shows that over this 30-year period, you can almost pick any period that you want. REITs have outperformed the Dow Jones Industrial Average, the S&P, the FTSE REIT Index, and bonds. It's just been extremely compelling. And the reason why is I think that REITs have, the reason for the performance and the reason why I think it's a great vehicle is REITs have a lot of things going for them. Number one, if you go back to this prior slide, when a lot of these companies went public, many of the better companies in the real estate industry went public. You think of malls, you think of Simon, public company. You think of malls, you think of Taubman, went public. You think of office buildings, you think of Boston Properties. You think of storage, public storage. And all these companies went public as REITs. That's number one. There's low levels of leverage. And as we saw during the last 3 years, one of the most poignant lessons, y'all come on down here, through the last crisis was that debt matters, leverage matters, maturities matter. It's a common theme that you'll hear today, and they're low leverage vehicles, especially compared with many other owners of real estate. And those great management teams I mentioned, they're aligned with their investors because, in effect, they're shareholders too. They're working for the benefit of the shareholders. It isn't another company managing the real estate. So I think that that's another key part of it. And one of the other key parts of it, two other key things, is transparency. We report our information on a quarterly basis. We tell you what's happening with our rents. If you go to our website and you look at our financial supplement, you have every property listed, what the occupancy is, how our rents are trending. You can get more information. You'd have to, you could have a lot of fun spending a couple hours if you're really bored at night looking at that supplement. But they're transparent. And then you've got liquidity. If you own a shopping center or an office building, you've got to, and you want to go trade it, it's going to take you time to trade it. But if you got Regency stock, and you own stock in Regency today, and you think that dummy that was speaking today, there's no way that the CEO of that company makes any sense, so I want to sell that stock, you can call up, you can't do it right, well you could, but you'd have to run out, but tomorrow morning call up your broker and say I want to sell Regency or I want to buy Regency. One of the other key parts of the compelling reasons to invest in REITs is a significant portion, as you can see from this, 60% of the total return comes from the dividends. REITs, as we talked about earlier, have to pay out 90% of their taxable income. But let me mention something else here. The key earnings metric for REITs is funds from operations. Anybody know what that is? How you get there? You basically take your net income and you add back depreciation, because not all of the book depreciation that's baked into to book net income or taxable net income is real depreciation. There is some that we have to spend. And REITs are not just a phenomenon in the U.S., it's a global phenomenon. Almost $900 billion across Asia, Europe, and the Americas today. So it's a global phenomenon. It's a vehicle that, because of the attributes that I just went over, I think is going to continue to play a bigger and bigger role in the real estate industry. So now let's move on to a subject that's near and dear to my heart: Regency centers. Wayne covered some of this. If anybody can read that, you've got eyes better than Superman. But let me just I can make up stuff because you can't read what's on there, right? Regency was formed in 1963 by my parents, or by Joan and Martin Stein, who happened to be my parents. They built the first major regional mall in Jacksonville that opened up in 1967. The mall was expanded in 1981. My father happened to pass away in 1988. In the 80s, we kind of expanded outside of Jacksonville, and also expanded into, we built our first kind of major non-mall shopping center in Tampa, Regency Square, Brandon, which has got a big AMC theater and a TJ Maxx and Marshalls, Staples, etc. In 1993, the company went public. The company went public with 20 properties and a total market cap of $150 million. And we did another kind of seminal event occurred in 1996. It's kind of an interesting story here. There's a company called Security Capital. Bill Sanders, who was one of the real titans in the industry, they made a significant investment in our company. And then in 1997, we greatly expanded out of the state of Florida. We bought a company called Branch Properties, which was a great Atlanta company, had a great relationship with Publix. In 98, we bought a company called the Midland Group, which gave us, expanded our relationship with Kroger, let us expand into the Midwest. In 1999, we merged with a company that Security Capital also had a major interest in, called Pacific Retail Trust, which made the company Regency a national company. In 2003, Security Capital sold, 2002 or something like that, Security Capital sold to GE, so GE owned 58% of our stock, but in 2003 we got rid of what we called the GEs with a public offering that took them out, and then in 2005 we made another large acquisition buying a company called First Washington that gave us a major presence in the Washington, D.C. market. So that's kind of the sum and substance what's on that there. Today, and this is I think as of 6:30, I think some of these market cap numbers are probably down since then. It's been a pretty volatile market, as we all know. But today the company's got a total more equity and debt market cap at over $6 billion. We're traded on the New York Stock Exchange. Regency's a member of the S&P 400 mid-cap index. National portfolio, as you can see, about over 50 million square feet. But a pretty, remember I said started with $150 million of basically properties based in Florida, and now a footprint in most of the major markets in the country. You know, anything that you do, or any company that you have, you got to distinguish yourself. And you might say, all right, Stein, how is Regency different? What is it about Regency that makes it a good investment? And there's, I think, 5 key parts, and a lot of these things will be repeated over the next few minutes. High quality portfolio of grocery anchored shopping centers. That's one of our core beliefs. We can also develop properties. We can manufacture really good shopping centers at attractive returns on capital. We recycle capital. We sell property. You don't always make great investment decisions. Trade areas change. Supermarkets change footprints. They may have loved your shopping center one day. For whatever reason, we're going to sell centers where we perceive there's a risk. The buyer obviously thinks they're making a good buy. Sometimes they're right, sometimes we're right. And we buy centers where we can get reliable growth in future NOI. So we're making that trade, and that's a key part of our strategy. And as I said, we believe that balance sheets were important throughout our history, that you got to have a strong balance sheet and access to capital. But boy, during the 2008 crisis, that was just reinforced. And I think that's something that, whatever property sector, whatever company that you have, the extent you can influence is, balance sheets matter. And the only thing that might matter as much as balance sheets is any business. People say, the key to real estate is location, location, location. Yeah, location, location, location is important. But the key thing in our business is having a great team. It's management, 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 people, people, people. And we emphasize that a lot, and it's a key part of our... So we're starting with quality properties. What do you mean by quality properties? Quality is it can mean a lot of things. To us, it means dominant anchors, and it means strong and dense demographics. As you can see, and I'll show you some more information, but our supermarket sales, our average supermarkets generate $25 million a year in sales. And why is that important? Right, exactly. 18,000 average shopper visits a week to our shopping centers. So 80% of our portfolio is supermarket anchored. We believe in dense demos, and where our trade areas where we are have buying power. 87% of the portfolio is in the top 50 market. Our average household income is $96,000 versus well above the national average. We like high barrier to entry markets. That means it's a market where it's tough to get a property zoned. That's a pain in the rear when we're trying to get something developed. But when we have a piece of property, you want to be in those kind of markets because it's going to allow you to have what we call a sustainable competitive advantage with your strong supermarket anchor. Here are our anchors. It's the best national chains in Safeway and regional Safeway, Publix, and Kroger. Look at their sales, well above their averages. And we also, H-E-B and H-E-B's in Texas, kind of the Texas equivalent of, anybody from Texas? They're great. We got a couple of Wegmans up in the Northeast. They're dominant up there. We like Whole Foods, the specialty grocers. But when we go back and we look, when you go through a period like you did in 2009, in early 2010, we said, all right, last 10 years we had a lot of good times. We've had some tough times. So what are the attributes that make sense for properties? And it was above average household income and supermarket sales. So the more things change, the more they, in effect, stay the same. And as you can see, this is the map again of our footprint. And 50% of our properties, of our net operating income, are in San Francisco Bay Area, Metro LA, San Diego, Dallas, Atlanta, and DC. High quality portfolio, it isn't just that she can put on the front of the brochure, but what kind of results does it produce? And if you took this thing back another 9 or 8 years, and you look back up there to, let's see if I can make this work. Yeah. Back pre-recession, we had 10 straight years of 95% occupancy plus, and most importantly, 3% same property NOI and rent growth over 10% a year. So that's where you want to be. But then obviously we went into the Great Recession, and as I said earlier today, if you would have told me that, and you'd have said, hey Hap, things are going to get really tough. We're going to go through the worst recession in your lifetime, and you tell me that my occupancy was not going to get below 92%, I'd say, hallelujah, where do I sign? So we think that we've held up pretty well, but obviously one of our key objectives is to get back up to 95%. And where do you think we need to do that? I mean, is it on the anchor side of the space, or is it on the small shop side of the ledger? Yeah, you can see what's happened to us is our spaces over 20,000 feet, we've maintained occupancy at 98%. It's the small shops. What's also interesting to note, what percentage of our small shops do you think are chains? 60%? You're 50%. So, you know, it's interesting when you think about it. Over half of our our spaces under 10,000 feet it's Subway, it's Starbucks, it's J.P. Morgan Chase. The banks are expanding a lot now. It's Panera Bread, it's Five Guys. But in order to get back up to 95%, we got to get this leasing back up to 90%. If we do that, we're going to have this 3% same property. You know, I talked about our development capabilities. We really think that the Regency has a unique combination of in-house capabilities. That means we got a development staff that's dedicated to development. We've got great anchor relationships. If you go back to the map, you may not remember, but there's 17 big dots, and that's where we have locations, so we can be close to our properties and close to our markets, which we think is a competitive advantage, both from a leasing standpoint and from a development standpoint. We're not going to develop like we did pre-recession when we had a $3 billion development program trying to start $500 million of new developments a year, but $150 million of new developments, redevelopments, where we got strong anchor sponsorship like Publix and demonstrated demand for the small shop space. We think that's something that makes sense, and we can add value in our existing portfolio through redevelopments. And we'll talk about some of our, here's one. Now, look, this is a shopping center from any of y'all in Jacksonville that's in Neptune Beach. So this is not, I got one that's in enemy territory coming up, but it's in Seminole Beach, Florida, so that's the reason why it's called Seminole Shops. But Publix was in an undersized store across the street. They relocated into this shopping center. Their sales are extraordinary. We leased the center up just like that. And the returns on invested capital, that's on an unleveraged basis, is 9.5%. So it just, in effect, checked all the boxes. This was a location that Walmart got turned down from doing both a supercenter and a neighborhood store, so high barriers to entry. This is closer to home, Millhopper Shopping Center. This is a Publix anchored shopping center. It wasn't so pretty about 2.5 years ago, but we redeveloped it. Publix expanded, did a total tear down rebuild, and it's made a good, solid center, a great center, which we think is going to have a sustainable competitive advantage for the foreseeable future. We talked about capital recycling. We're going to sell low growth centers where we perceive there's a risk in those shopping centers, and buy centers in high barrier infill, market dominant centers, and these are going to be centers that have sustainable competitive advantages, and over time it's going to enhance our NOI growth profile. This is a center that we sold. Dominic's is owned by Safeway. They're not doing real good. Anybody in here from Chicago? As you know, Jules the guy. Jules the Publix. Nobody here is involved with Winn-Dixie, are they? Jewel is the Publix, and Winn-Dixie's doing some good things right now, and Dominic's is the Winn-Dixie. But Dominic's is even doing worse than that. This center, remember, our centers average $500 a foot. This thing's doing $175 a foot. $2,350 is about twice, almost twice what the rent that supermarkets pay in this market. So we saw, you know, look at all the vacancies in the shopping center. doesn't meet our criteria. We like the Chicago market, but this is probably a lower demographic area. So this is an enemy territory, but you know, this is a center that we developed in a place called Tallahassee, Florida. And it is the shopping center for Florida State. Publix's volume is extraordinary there, and we were able to buy it on a very favorable basis. This is a shopping center in Minneapolis. It's got Whole Foods as an anchor. Their sales are over $30 million a year. The other tenants are Caribou Coffee. I know it's kind of a Starbucks, Chipotle, just a great lineup, and in a great area of Minneapolis. It's near downtown. It's another center that we recently closed on in Austin, Texas. You know, we love university towns, even Tallahassee. And the HEB there sales are $70 million, just unbelievable. What a great addition to that. It's a great trade area. It's the best shopping center at the intersection. It's going to be the dominant center for a long period of time, sustainable competitive advantage. I mentioned that balance sheet's real. Yes, ma'am.
Why do you say university towns are favored?
What's interesting is if you look at the demographics or the average household income, because of all the student population, it's not so great. But typically, university towns have a lot of college professors and you got the what do you call it? The sociographics. You got people with a lot of smarts. They don't like to see a lot of development. It's hard to develop there. You have more. Even for every dollar of income, you have more sophisticated buyers there. And in the case of Millhopper, it's not located. It's not kind of the university Publix, but in case of Ocala Corners in Tallahassee, you know, it is. So we just, you know, Austin, Texas is a great city. You'll have you know, it's also the state capital, which is another combination that we like to see. Good question. Yes, ma'am. Well, you mean, but Cold Stone food / ice cream, yogurt, and Starbucks coffee. Yeah. Yeah. So what you want to get, in our view, we have what we call a premier customer initiative. And what we're trying to do by that is to get the best side shop retailers, Cold Stone, Starbucks, Caribou Coffee. And you wouldn't put Panera Bread. And sometimes Panera and Starbucks don't like being in the same shopping center together. One will try and keep out the other. That, you know, even local restaurants. And if you can get the better side shop retailers together with the best anchor tenants, then you've almost got a secondary anchor from the better side shop retailers. So we do try to, as best we can, merchandise as well as we can. Now, if you look at most, we call ours grocery anchored neighborhood and community shopping centers, or neighborhood or community shopping center. But that's pretty much of a cottage industry. And you compare it to the mall business, which is more sophisticated. You have more repeat of, you know, who the tenant lineups are in malls. But we try to do as best we can to merchandise the shopping center. So balance sheets matter. And just out of curiosity, in any of these metrics up there, there's debt to cost, debt to EBITDA, fixed charge coverage, NOI unsecured. Anybody have any thoughts on why any of those are important? Bless you. Well, why is that? Right. Right. Well, what's happened was we were selling properties for earnings, where you can sell property, and we don't sell property. We don't include transaction profits. That's the reason why our EBITDA is low and our NOI reduced during the middle of the recession. But you want to move that metric in the right direction, which is continuing to lower that. And while that's maybe better than debt to cost, because it has an impact on where your earnings and where your net operating income is. So that's obviously real important. Your fixed charge coverage is important because it tells you how much coverage you have your earnings to fixed charges. And NOI and secured is important. Anybody have an idea why that makes any difference? Although we put mortgages on our properties in our partnerships, and we'll talk about those in a little bit, and our partnerships make up about a third of our assets, of Regency share of the assets. On our own balance sheet, if we're going to borrow, we borrow with corporate debt. So anytime we want to sell a property, we can sell it without getting the mortgage lender's approval. And then when times are really tough, like they were in 2009, when the public markets were closed, we were able to put mortgage debt on some of our properties. So it gives you a lot of flexibility. And here's our partnerships. We've got partnerships, and what our partnerships allow us to do is to expand our footprint, $3.5 billion, another 20 million square feet, and you're basically leveraging your capital and leveraging your management team. It produces about $25 million in very profitable third-party income. We've got some great partners. GRI is basically CalPERS, State of Oregon. CalSTRS is the California Teachers, USAA, and an Australian partnership that's getting smaller. Some great partners, and it's an important part of Regency's strategy to make sure that we have access to capital and that we can profitably expand our footprint. I mentioned people management is important. We've got a cycle-tested management team, 400 great employees. About half of them are in headquarters. The other half are in our 17 offices. In those 17 offices, not only give us a national presence, but also allow us to be the local sharpshooter. And we focus on, what's our employee engagement. So this is kind of the virtuous circle that we focus on is generate dependable NOI growth, make sure we have access to capital and a strong balance sheet, we create value through good investments, and you have a strong portfolio, great management team, and balance sheet, and we're built around that. These are kind of our earnings metrics. If interestingly enough, if you'd have said, or 5 years ago, our projected growth rate would have been 10% plus. But when you look at lower levels of leverage, most of it coming from NOI, some from development, a growth rate in the range of 4 to 7% is something that we think is sustainable. And you're paying out a 4 to 5% dividend. That's a 10% total return, with 50% coming, from dividends. Is something that's going to be attractive to shareholders. So that's all I prepared to say. But I can try to answer questions as long as they're not too tough. Yes?
You said that you have 17 offices all over U.S. and you're trying to locate a shopping center near them so it's easy to manage and develop. But every time you open a new shopping center, how do you ensure that your shopping center is not competing with another shopping center in the same region?
You mean one of the other ones that we own?
Because are you trying to locate them near your offices? So
Well, no, but like for instance, we manage Gainesville out of our Tampa office. So it's not, in our office in Tampa isn't right next to all of our shopping centers. Secondly, the shopping centers we want to own are going to have what I call sustainable competitive advantage. They're going to have the best anchor, be located in a trade area that we like. So typically, very rarely is there going to be an overlap of two shopping centers in the same trade area. There are going to be exceptions to that rule, but sometimes we'll own a couple of corners where it makes sense to do that, but that's the exception rather than the rule. Because there's usually only one shopping center that's the dominant center, and that's the center we want to own. Yes, sir.
Sounds like when you have a center or whatnot, you're trying to get the right mix of properties inside of it. Do you actually market to the direct type people when you get there, like go to Starbucks and say, hey, you guys should open up a store in this center, or how does that work? Get the right mix.
Yes, but you do that, but sometimes they may be in an existing location in the market and have a longer term lease, so you can't. And then you already own a shopping center, and some of our spaces, are like, just say like a new concept that's coming out, whether it's Five Guys or Five Guys or Smash Burgers in that center in Jacksonville. We may already have a burger shop, in the space, or the space that they want may already be leased to some other tenant. So you've got those dynamics that you're always playing with. But we'll proactively go out and try and get the best tenants that are going to help make the shopping center the dominant center for the long term. Yes. Well, I think that putting together a single real estate operating entity that has a long-term time horizon, as opposed to a private equity, closed-end private equity fund that has a 7 or 10-year horizon. So if you want to talk about a real estate operating company or partnership, so I think that's starting one, that has low leveraged and a management team that's got alignment of interest, with the investors. So I'd put any entity that has low leverage, alignment of interest, a talented, focused management team up there, because there's a company called Forest Cities, which is a mall company, but it's not a REIT, but it has all those attributes, although it doesn't have low leverage. But anyway, if you have all those low leverage, all those low leverage, a long-term horizon, a focused, talented management team that's aligned with interest with your shareholders, meaning it isn't heads management wins and tails the investors lose. That starts out. So then the advantage of a real estate investment trust is you don't pay taxes as long as you distribute out, in effect, 100% of your taxable income, or about 70% of your cash available after dividends. So that's the advantage. The disadvantage is the only thing that you can retain is that 25 to 30% after dividends, as opposed to a real estate operating company. So I'm not. I will say that the lion's share of the successful, dominant, best-in-class operators are formed as REITs today, of the public companies. And the advantage of also being a public company is as you saw, we have a number of partnerships. So we can go to one of our institutional partners to raise capital, which we did in 2009. We can put mortgage when the public markets were closed. We can put mortgages on our properties, and I'm not just talking about Regency. I'm talking about any public. We can put mortgages on our properties because we have most of our properties on balance sheet are unsecured. And then when the public markets are open, we can go to the debt markets or we can go to the equity markets. So I think there's a lot of advantages to being public that outweigh the disadvantages. And the REIT structure seems to work, and a lot of the better operators, once again, whether it's Simon or Boston Properties, Public Storage, Ventas in the healthcare area, Avalon Bay and multifamily are REITs. You had a
Most of your investors tax exempt?
well, let's talk about those investors are our partners, where we'll own 25% of what we call a co-investment partnership. In California Public Employees Retirement System, owns the other, or in that case, it's we own 40%, they own 60%. So that's our, and in that case, our partner is a tax-exempt entity because their investors are, when they pay out their pension distributions, then those investors will, in effect, pay taxes. Now, the shareholders in our company may be CalPERS, or it may be a mutual fund like Cohen and Steers, or maybe a asset manager like Morgan Stanley Asset Management, and they may have different investors like some of these state pension plans. And some of their investors may be taxable entities, like you want to go out and you can buy shares in mutual fund shares in Cohen and Steers or Invesco or American Century, a number of other REIT mutual funds. So it kind of depends. Yes. So the interest is paid at either the investor level or the shareholder level. But some of the entities that are investing are also non-taxable entities, but when they pass on, eventually it gets paid by the shareholders or the investors, not at the corporate level. Answer your question? Right.
It's kind of curious how tax exempt is coming through a REIT and not just through the partnership rights of the property.
But the advantages, forget the tax advantages there. The advantage they're getting, once again, is they've got a well-capitalized company with, and I'm not just talking about REITs, I'm talking most of the REITs that are out there, with good management teams, a focused strategy. Most REITs have a single focus of whether it's shopping centers or apartments. They know those businesses well. They know the markets they're in well. So you get those other benefits.
You mentioned that you don't consider the industry to have really taken off until 91. Is that right? And Regency went public in 93.
Right.
Would you consider Regency to have helped shape some of the REIT industry growth in the last decade and a half? And if so, what do you think the major contribution was?
That's a flattering question. I wish I could, Regency, in terms of size, believe it or not, with $6.5 billion market cap, there's probably 20 to 2 dozen other, there's 150 REITs. So I think we're one of the better REITs, one of the larger REITs, one of the larger footprints. But I don't think it wouldn't be right for me to say that we shaped that, because there's probably 20 REITs that are larger than the company, than Regency is now. But I think where we've contributed is we have, I've been focused on best practice. We've been focused on a lot of transparency. So I think that I'd like to think if you were to get one of the major dedicated REIT investors up here, they'd say that Regency is one of the better companies to work with.
I can actually say some good things about you. You can't, but I can. I mean, all those acquisitions that happened, they rolled up because they were best in class. And they have got all this access, and they're doing partnerships with people because they come and they say, who's got the best operating platform? Who's got the strongest management? And they're the dominant grocery center REIT in America by a wide margin. So they're, I think that as companies mature, they tend to sort of attract and absorb the other ones. And these guys really have this one.
That was the last comment for sure. Thank you. You had a question?
Yeah, I just want to ask, you said that REITs tend to specialize in certain market, like shopping center, apartment, but do you ever consider diversifying to different markets just so that you can reduce your risk rather than just keeping all eggs in one basket?
Well, if you go back to the map, or think about it. I mean, we're from, Washington, D.C., Florida, Raleigh, Durham, Texas, Denver, coastal California. So we're in, very diverse markets with very diverse economies. Now, if you're talking about from a global diversification standpoint, we're not, but that comes with its own set of risk. And to date, and we've looked outside of the borders of the U.S., but have not found anything that made sense to date. And we're not looking today, because the growth in the world today there's going to be a lot more growth in Brazil and India and China than there is going to be in the U.S. and even Mexico, and there's not a more stable country in the world than Canada. But there's just a lot of challenges to doing that, and for now we're going to leave that to somebody else to mind those. Yes, ma'am.
Does your public number include any Greenwise?
No.
Are you in one of your shopping centers after?
You mean as far as Greenwise is a section in the Publix, or Greenwise is
As the actual store?
No, I think they only have a handful of those stores, and I don't know how rapidly they're expanding it. It's interesting. I have one of my colleagues, I would call, let me see if I can say this right. My wife and I, you might accuse us of being foodies, but one of my colleagues' wife is she's a granola cruncher. She's organic, and Michelle Chandler just, look. So anyway, we buy a lot of organic stuff, etc. But anyway, but she's really serious about that stuff. And we were talking with, I was talking with my colleague, and he said, 'cause I mentioned my wife wanted to buy some little stock in Whole Foods, and he said, Hap, I'm just not sure that's going to be a good investment. I said, Mac, what do you mean? He says, because, and they're from California, so in their market, Safeway's the dominant, but Safeway's giving more and more space to organics. So I think what Publix is probably, because they really haven't expanded the Greenwise concept as separate stores, from what I can tell, very aggressively, but they're expanding the amount of space that's taken up by organics in the stores, if that makes sense. Oh.
Really like you have some good partners and investors on your side. I was thinking in terms of management decisions and investment decisions, how often these partners, they interfere or they, try to influence your decisions, especially investment decisions or management.
Okay, so our partnerships, whenever we buy something in one of our partnerships, that's done in consultation with our investors. But you have a pretty well set mandate and pretty well set rules of engagement. The mandate is, like us, they want to invest in grocery anchored shopping centers. We don't want to confuse what our team is buying, so we're having to buy brand X for one set of partners and brand Y, and that's just kind of like buy what makes sense and that's consistent with Regency's strategy. And we, more often than not, what we like to be able to do is to be able to say to our partners, we're going to buy it whether you buy it or not. There's a couple of our partners that are in a rotation, so anything we buy, they have to be offered the property. So that's the way, in any financing decision or major decisions in those partnerships are made in conjunction with our partners, but we've already got a pretty well agreed to and consistent strategy that's already there. So you didn't like you're having to have a come to whatever meeting very often. But any major decision we're going to say. So now, let's talk about our shareholders. We have a number of large shareholders, and It's interesting, 90% of the stock in Regency is owned by institutional investors as opposed to retail investors. And the vast majority of those investors are what are called dedicated REIT investors. Meaning that if you're an investor, say you're CalPERS or whatever, you're saying Cohen and Steers or Wellington, I want you to go out and invest all this capital or 90+% of this capital in REITs. So, and there's probably 10 or 15 dedicated REIT investors that we know very well, some of which are investors in the company, some of which are not. And so we're meeting with them on a regular basis. And they are, they're trying to find out, like right now, what obviously the key question they're asking us is, how's leasing going? How are the mom and pops doing? I mean, you think about that, that's the obvious question that if you're an investor, that's the dadgum question we're asking our people every day. But when I was in New York last week, that's what every investment meeting, every meeting we had, it was, well, tell me how small shop leasing's going. I mean, that was the first question out of everybody's mouth. So, and then every now and again, either in a meeting, or they may pick up the phone and say, what about this? Or they may say, why in the heck are you doing that? And that usually, at least if they're calling, they haven't sold the stock yet. With them? Well, obviously if they want to buy a REIT stock, they just call up their broker or their trader and they buy however many shares they want to buy. If they want to sell it, they sell it because it's publicly traded. We're up 90 cents today. That's almost, unfortunately, that's almost 3% today. So anyway, but so at $36, $37 a share, they can buy or they can sell. If they want to be in one of our partnerships, we've already got what I call 4 active partnerships, and I can't imagine us wanting to start a new partnership from scratch. If somebody wanted to come with us and said, we have a $1 billion portfolio here that meets the criteria that we just went over, great anchor stores in the right locations, would you buy 25% of it, and we like the governance rules of that partnership, we'd give strong consideration to that. But to start a new partnership that's management intensive. We've got a separate group. I mean, if you're a property manager or a leasing person or an asset manager at Regency, we don't want you to be worried about who owns the shopping center, whether Regency owns 25% or 100%. However, we've got a separate group, a small group, that when they wake up in the middle of the night, they're worried about, are we doing the right thing for that partnership? Yes, sir.
Your father built retail development, but not necessarily grocery and shopping centers. But they also did other kinds of real estate. When you decided to pursue this venture and go after grocery and shopping centers, what were some of your thoughts? As you looked at the different real estate types that your family was familiar with.
So, in 1981, we expanded Regency, doubled the size of Regency Square Shopping Center, made it the dominant center, and my mom, we added Sears in addition, and Ivy's, which is now Dillard's, went into the expansion also, doubled the center. It was really successful. And my mom was on the Federal Reserve branch board of Jacksonville. And she was good friends with, what's the name of the university down in Titusville, the State University, or Melbourne? FIU, is it? FIT, I think. So, and they had a site that was a great mall site. So at the time, so my dad goes, and the key to this site was Burdines, which is now Macy's. So my dad goes to talk to a guy named Jim Solonic, who was head of real estate with Macy's, and he says, I think I can get control of this site. I think I have control of the site, whether he did or he didn't, but anyway. And would you be interested? And he says, yeah, we'd be interested, Martin. But I want to let you know that DeBartolo, which is now part of Simon, was a major developer at the time, much bigger than we, but they've offered us free land and $2 million cash. And I think Dad said, you know, I don't know that we can compete in that business, in that arena. So so the mall business kind of, just the bigger players, the CBLs, the Simons, the DeBartolos, they knew how to play that business, and they were bigger and better than we were. So that really wasn't an opportunity for us. We also developed a decent amount of suburban office space and some downtown office space, and kind of mixed success. But what we found out were a couple things. Is number one, if we get $1 of net operating income, NOI, rents less expenses, okay? Net operating income, that about 90 to 92 cents on the dollar goes to the bottom line. You got to put, we spend about 55 cents a foot on deferred maintenance. You got tenant improvements, and that takes up about 10%, but you get 90 cents on the dollar. You go in a suburban office building, the amount that you're spending in tenant improvements, building improvements, free rent, downtime, of every dollar net operating income, you can be easily spending 30 cents on the dollar going to those other things. And in addition, occupancy, you don't have the stability that you have with the anchor tenants in the community and neighborhood shopping center business. So that kind of segues into why, community neighborhood shopping centers. You got the dominant anchors. We're lucky enough in this state to have one of the great supermarket chains and one of the great retailers in the country. You can work with them. They can. You get those close to 20,000 shopper visits a week. Yeah, you are dealing with a lot of side shop space. But as you've seen, overall occupancy through the Great Recession is 92%, and I believe we're heading back up to 93% hopefully this year, and get to 95%. So I think it was a business in which we could compete in. I think we understood the formula for success. We understood that in a suburban office building, anybody can build something next door and be competitive. It's more of a commodity business. Once you've got the right shopping center in the right corner, especially if you have the right anchor, you've got that sustainable competitive advantage. So that was kind of the thought process. There were a lot of aha moments throughout it, but I think where we ended up is a strategy that we know, we understand, and we think that we're continuing. We're learning from our mistakes, and we've been in this business, in effect, the supermarket anchored business for 25 years now. And we're much better today than we were 25 years ago, and hopefully we'll be better 25 years from now than we are today. Any more questions?
I have a question. I don't know very much about real estate, and so I've been. Can you go back to like the second or third slide where you had the indices and the S&P, and then your rate of return? Can you help me understand some more about that?
Well, I think the slide that'll show that the best. I always worry about somebody that says, I'm just an old country boy from, all right, I'm just an unsophisticated real estate investor here. So the average annual return of about 12% is what REITs have generated since over this 20-year period. And 60% of the return comes from dividends and growth in dividends, and 40% from stock appreciation. And in theory, if your multiple stays the same, and the way I look at it is, another way of looking at it is, getting back to what our business plan is, we're paying, what it is today, but about a 5% dividend. If you buy the stock today, you're getting about a 5.5% dividend. And if we can grow our earnings, which allows us in effect to grow our dividend by 4 or 5% a year, in this simple country boy, this unsophisticated, it's about a 10% return. If you add the 5% cash yield to the 5% growth. Go.
This question might be a little off-base, but with the economic downturn and everything else, and kind of like a lot of protests starting up, is there any concern for like security or whatnot in some of these sites that vandalism might be a potential impact?
Yeah, I mean, related to what's happening near Wall Street today?
Exactly.
No, I mean, because
the flash mob theft, where they have like everybody show up in a Walmart, strip everything in the stores and leave. That was happening kind of last year.
Securities in most. I mean, we just sold a center in Houston where we had, different kind, where we had like 2 or 3 deaths in the parking lot. It was just in a not a nice area. That was over a 5 or 10 year period. It wasn't, but not that most of the areas we're in. I mean, I just can't imagine. Not to say it can't happen, but Millhopper shot. But if you're a protester or a terrorist, say, you're going to want to do a more high. I mean, it's not to say it can't happen, but you're going to want to higher profile, higher impact location. I mean, you may remember the sniper in Washington D.C. and we had that, and somebody got killed at a Home Depot that was across the street from a shopping center that we own. But it's not to say that kind of stuff can't happen, but I don't think you can, kind of bury your head in the sand. Not bury your head in the sand, but you just can't. I don't think there's our product type and the locations lend themselves to those kind of things. Not to say it can't happen.
Part of the 99%, so on the safe side.
Oh yeah.
More kind of observation. You're saying that stocks and REITs in general are returning 9%, but over long term, whereas REITs are 12, that difference is 33%. Because there was an awful lot, like 90% for the tax rate. What is your comment on that? What do you think you guys should be?
It could be that's. I mean, I really haven't thought about that. I don't know what it's interesting. I don't know what the effective tax rate that the corporations are paying in America today. And in addition to that, as you may remember, if you take our depreciation, which you have for tax purposes too, I think even if we were paying at 35%, our effective tax rate on distributable cash flow would only be 10%, and then you add to that. But on the other side of the coin, we wouldn't have to be paying out so much of a dividend, which is kind of a plus and a minus. We could retain more of our cash flow. So I'm not sure. I'm skeptical of the thesis that you threw out there. It's not to say it couldn't be true, but I don't think it is for those reasons. Somebody else? Yes, sir.
Maybe switching gears a little bit from the nuts and bolts, but in the small group session we had, you said that one of the main things you should look for when you're finding a job is to just be with a good company and kind of go from there. Can you describe your corporate culture and how you kind of foster that attitude?
It's a good question. And just to repeat, any guy's going to be in the job market, and you will be soon. Look, the following attributes I think are important is find a good company that's got a good sustainable business model. And you're going to be working with people that you like and respect, because I think that's that you're going to. where you got a potential. It's interesting that Steve Jobs thing that I mentioned addressed. It's love what you do is part of the. You have a passion for what you do and be in an environment where you can. So what do you do? I mean, number one, I think that you got to kind of walk the talk, meaning if you say you care about people, you got to do the big and the little things, all the way from compensation. You got to compensate people reasonably well. Got to give people reasonably, good benefits. You got to genuinely care about people. You got to emphasize. I think our company builds 17 habitat houses around the country every year. We have a pretty strong employee matching program. As far as if you make a contribution, we'll do that. We do. It's also we do some interesting things, and not that. I'm obviously I get paid more than anybody else in the company, but we have a profit sharing plan, and I see companies where the CEOs have these generous pension plans, and they're also making multiples of what the average person in the company is making. But when on our profit sharing plan, my percentage participation is capped at $50,000, as every other everybody else. So, that's not we take half a percent of our earnings goes into that plan, and my secretary gets the same amount of that I do. And I don't know how many people, so we work on developing, allowing, development plans for people. We do a lot of 360 reviews. I think we try to hire good people, and I think in anything you get in these virtuous cycle. You hire good people, and other people want to go work for with other good people. And I think that's the key thing is we've really got a great group of people. We emphasize a family atmosphere, and you can't be perfect at that stuff. And as I mentioned in the earlier session, one of the things that we do these employee engagement surveys. I mean, one of our top 5 objectives, as you saw up there, was at 85% plus employee engagement. I don't know how many other companies say that's hey, we're putting up we're going to put up there and measure it every year, and this is a key objective that we have, and we take these we have a third party that takes these surveys every year. But we've got issues. We're not great at on the employee development area. One of the things that I mentioned earlier, we kind of slice and dice these surveys. 17 offices. Which 17 of the 17 offices isn't doing good? Or in our accounting group, are we doing as good there as we are with our property managers? And the thing that we're not doing as good in employee engagement is your generation, the Generation Y, and so we're trying to figure out how to do better at that. And we'll see. So I think it's a priority, and you gotta walk the talk, and it just can't be lip service, because it's hard to move that needle. There's just a lot of issues out there. People have their own agendas, but anyway.
Tradition, a great business. We really thank you for coming over and sharing with us.
Well, thank you for having me. It was a great treat.